borrowers. My name is Steve Doherty. I'm the Raleigh VA loan guy. Today I'd like to talk a little bit about VA assumptions. So there's quite a bit of buzz about VA assumptions because we've entered a period of relatively high interest rates, at least compared to where they were during the COVID period, right? 2020 through 2022. So now that interest rates are higher, a lot of VA borrowers are on the hunt to buy a home that a seller already has a VA loan on. Maybe they bought their home in 2020 and bought with a 3.125 interest rate. Or maybe they bought in 2010 and refinanced during COVID like nearly all the rest of homeowners in America did, and they're sitting at a similarly low interest rate. Well, wouldn't it be great if I could just step into the shoes of that seller and take over their interest rate at 3.125, maybe even lower, take that interest rate over and avoid the higher rates of today's market? The problem with that strategy is the VA assumption is kind of like a unicorn, and it looks like a fantastic opportunity on paper, but once you look at the details, it may be more difficult to capture or to capitalize on those benefits than it may first appear. So for starters, the maximum that loan can be is whatever the balance is right now. Now, this is somewhat debatable. Some people will tell you that you can go up to the original balance of the mortgage, and I've actually got that guidance personally from the VA on one occasion. That's not really what the regs read out as, and that's not the kind of official guidance from the VA. So let's say a person buys a home in 2018, and they pay $200,000 for it. Now they're turning around and they're selling that home for $275,000. Well, the balance on that mortgage is not even $200,000. So that means you can only borrow the current mortgage balance. But let's say there's a $100,000 difference between the current balance on that VA mortgage and what the seller is asking for in a purchase price. How are you going to cover that rest of that gap? You could pay cash, which sort of goes against the main benefit of a VA loan, in that a VA loan offers you 100% financing. You don't need to make a down payment. The other thing is, in order to cover that gap, rather than making a large down payment or coming up with that cash yourself, you could get a second mortgage, what sometimes we call a piggyback second. So maybe it's a home equity line of credit to bridge that gap. Again, the problem here is that second mortgage plus the first mortgage cannot add up to 100%. In other words, it can't add up to that full purchase price. So you're still going to make a down payment. The other problem is on that second mortgage, it's almost certainly going to be an adjustable rate mortgage. So now that the benefits of that VA loan are kind of starting to break down, rather than 100% financing, you're going to need cash. Rather than a fixed rate mortgage, not that you can't get an ARM on a VA loan, but rather than a nice fixed rate mortgage, that second mortgage that you pick up is probably going to have an adjustable rate. The other thing is, in order to assume that new mortgage, you're sort of at the mercy of the servicer of that mortgage. And it's just not a money-making activity for that servicer. The VA requires servicers of VA mortgages to follow through with VA assumptions if you qualify for that assumption. But they don't really have an enforcement mechanism. In other words, there's no real teeth behind that rule. They don't have a way of reaching out to the servicer and sort of holding their feet to the fire and making them look at your file and assume it. Here's another problem with the VA assumption. It takes time. It will take at least 60 days because, again, this is not really a revenue generating activity for that servicer. So if you're in a competitive market like Raleigh, North Carolina, Charlotte, North Carolina, any of the outlying counties around those two big areas, it may be really, really difficult to have your offer accepted if you're telling the seller you're not going to get paid for 60 days, right? That may really impact your ability to be a competitive buyer. I encourage you to follow up with a local realtor or preferred realtor on that question because that really is their area of expertise. So now we're talking about a potentially less competitive offer. We're talking about making a down payment, and maybe part of that mortgage financing is at an adjustable rate. So what's the alternative? The alternative is just to use your VA entitlement and go with 100% financing. Remember, After 210 days from your first mortgage payment, the VA loan is the easiest loan to refinance by virtue of an IRRL, interest rate reduction refinance loan. It's more cost effective than other refinance programs. It's not as laborious on your part. You do not need an appraisal. So once rates drop, your opportunity and ability to refinance is very, very high with a VA loan. So when you will probably be able to capitalize on that, almost surely be able to capitalize on that lower interest rate once rates drop. Now, this is not me saying that an assumption is a bad deal. If you can pull it off, it's great. You can get a much lower interest rate than the market currently dictates. But what I want you to understand that is it may not necessarily be the best option because the only benefit to it is the very, very low interest rate. So in summary, is a VA assumption a bad deal? Absolutely not. If you can assume that mortgage at a much lower interest rate, that's a great deal. But it's probably only really going to make sense in a limited number of circumstances. If the loan balance, the outstanding loan balance on that mortgage is fairly close to the purchase price, that's probably your best bet. That's going to be the easiest way to do a VA assumption. If the sellers have owned the home for a significant period of time, that almost certainly means that the balance on that underlying VA loan is lower or maybe even much lower than the purchase price. That's where you're going to start running into problems. The other thing is if you're willing to do this, you'd want to find out from the seller if they have approached their seller as to the feasibility of this VA assumption. Without that, you don't really know how long that assumption process can take. So if you have questions about this, I'd love to answer your questions. Drop a question in the comments below, send me a text message, shoot me an email. I'm here to answer any of your questions. Again, my name is Steve Doherty. I'm the Raleigh VA loan guy. I work for Advantage Lending in Raleigh, North Carolina. I look forward to hearing from you.